Hello, this is Jordan, and this is your precious metals video market update. This video is being recorded on the late evening of Saturday, June 2nd, 2018. Thank you so much for joining me today. And in this video, I'm going to discuss some market history which can help inform us as to what needs to happen for precious metals to begin a bull market. And so in this chart here, we're going to look at how gold stocks have performed against the various movement in the Fed funds rate dating back to the late 1950s, so over the past 60 years. And we use gold stocks here because they have a much longer history than gold. The gold price was basically fixed from 1933 until 1971. I mean, there were a few blips here and there, but essentially it's better to use gold stocks because they have a much longer history. And at the bottom we have gold, and so at the top we have the Fed funds rate, and in the middle that's the Barron's Gold Mining Index, and the vertical blue lines are points when the Fed funds rate peaked or the Fed finished hiking rates, and the red lines are when the Fed funds rate bottomed and the Fed was ready to start hiking rates. And what I've done here is with the lines I've mapped the blue, all the lines show various lows in the Barron's Gold Mining Index. And we can see that most of the time gold stocks make lows or they start bull market runs when the Fed finishes hiking rates, or when the Fed funds rate peaks or peaked. Now, there are some times when when it was the opposite, and gold stocks bottomed and took off after when the Fed funds rate bottomed, and so when the Fed was about to hike rates, most notably 1972 and 1976. However, there's other examples of that. There's 1993, 1999, and also 2016. Those three examples, what happened is you had a bottom in gold stocks. They went up, but they weren't able to sustain it. They just went up for a little while. It wasn't a real bull market. It was more of a rebound that ultimately fizzled out. And so we show the Barron's Gold Mining Index here, but I also want to note the S&P TSX Gold Index, the low in 1958. It had a much stronger rebound. And also in 1985, from 85 to the end of 87, that index was up 290%, and and that was more in line with gold. If you look at the bottom in 1985, that's actually when gold bottomed. That was just a few months after the Fed funds rate peaked there, and that probably was after the Fed's first cut that the sector bottomed and had a great run. So I just wanted to point that out, but it makes sense because it kind of dovetails with real interest rates. I mean, basically, precious metals need, I've said this too many times already in my work, but they basically need an acceleration in inflation, or they need lower interest rates, lower short-term interest rates. And so, those two lows in the mid-70s, 72 and 76, that's when inflation really accelerated. So it didn't matter that they were hiking rates. But most of the other examples, the bottom in gold stock coincided with the peak of the Fed funds rate and the start of a new cutting cycle. Now, this is the other thing that's really interesting. I mean, I think I pointed this out a year ago, but here I'm reviewing the 1999 to 2001 period, and there's so many similarities between the last couple of years and what happened 99 to 2001. Ultimately, I think 99 to 2001, or I should say, I think 2016 to 2019 is probably going to mirror 99 to 2001. So this time around, the cycle is a little bit longer. It's not happening as quickly. And so what happened here, which is interesting, is you go into 1999 and commodities, gold and gold stocks, devastating bear market in the mid-90s. It was the worst ever. until the one that we had now. And as you can see, if you look at the Fed funds rate, it was basically flat. It wasn't going anywhere for that period until there was some problems in the late 90s with the Asia crisis, so they cut rates once or twice. But anyway, that was smoothed over as far as the West. Then you get into 1999 and the Fed starts hiking rates again. What happened when they started hiking rates again? Well, you had a low around that time in gold stocks, gold, and also commodities. You could see that with the CRB at the bottom. And so what's interesting is you had a pop in gold and gold stocks and a really good move in commodities. But as the Fed continued to hike rates, commodities were able to rally with the stock market and make higher highs, whereas gold and gold stocks, they basically trailed off. They fizzled out as the Fed kept hiking rates. They consolidated, but they slowly went lower. And yet commodities continued to make higher highs. I mean, commodities were able to make their last higher high towards the end of 2000. And that was even when the Fed stopped its hikes. But up to that point, if you think about all those things, it's nearly a perfect comparison to what's happened in the last couple years. A terrible bear market in hard assets and gold, and then the bear market initially ends as the Fed starts hiking rates again. I mean, you think January 2016, and what's happened as the Fed has continued to hike rates? Well, commodities have performed a lot better than precious metals. Precious metals have not made a new high since summer 2016. I mean, they haven't even come close to it. So they've trailed off. They've been trending down in most cases, except for gold, but everywhere else. And so, considering what I just said in the last slide, and then focusing on this, it's pretty clear that unless there's some huge acceleration in inflation suddenly over the next couple quarters, the thing that is going to get precious metals to a real bull market is going to be when the Fed is done with its hikes, pauses, and then moves to a cut. I don't know exactly, when the bull market will start. Maybe it's when they cut rates. That's what happened at the end of 2000 or early 2001. I mean, gold stocks bottomed first, then gold bottomed 3 or 4 months later. But maybe because this time it's been longer, maybe it's just after the Fed's last hike. Maybe that's the point in time when precious metals make their next bottom and they start a real bull market. So I don't know exactly when it's going to happen, but it should be around that time. I mean, when the Fed is done hiking rates, that's going to be the time that precious metals are really ready to take off and begin a real bull market. And that will coincide probably with problems in the stock market and problems in the economy, because when that starts happening, that's when they're going to stop hiking rates and they'll move to a pause and eventually to a cut. And at the beginning of that, when problems come in and they stop hiking rates, that could probably be the time when gold is finally going to break out relative to the stock market and outperform the stock market, because that has really been, I wrote an article on this a couple weeks ago, that has been gold's missing link as far as intermarket analysis. I mean, if you look at this chart in the middle there, we have gold against foreign currencies. Last Wednesday or Thursday, that closed at a new 52-week high. I mean, I don't know how sustainable that is, but gold's held up pretty well with a really strong move in the dollar. And who knows, that could continue. But if you look at the bottom there, gold against the stock market, I mean, the gains we had in the first quarter, that's fizzled out. That ratio is now below the 200-day moving average. Gold also on top, nominal gold, the top chart there, that's also below its 200-day moving average. So those are worrisome things. I mean, gold has lost support at 1310 on a weekly basis. It traded down to 1281, but it rebounded to 1311 last week, and that kind of fizzled out at the end of the week. So, gold to really, reclaim a bullish position, it needs to make a weekly close above 1320. If that doesn't happen, the downside risk right now is to probably around 1260 or 1265. There's a confluence of support in that area. I'm thinking potentially, if gold trades down to the 1260s, around the time the Fed hikes rates in June, or maybe it's a couple days after, gold then could be set up for, another reflex rally, perhaps another move back to 1300. But we'll we'll see how that plays out. And sentiment, I mean, a lot of gold bugs are mentioning sentiment, but look, sentiment was encouraging. But when gold broke, I mean, gold broke below 1310 on a weekly basis. That was not an insignificant technical breakdown. And I mean, just look on the chart there. Look at the rally that gold had from 1281 to 1311. I mean, it was a really weak rally given the supportive sentiment that we had. So, sentiment usually follows price, but what we're seeing now is the price broke down, and now the price of gold, the trend, is relatively weak, and that is not good. I mean, sentiment is not going to bearish sentiment is not going to carry gold to a major breakout in the next couple months. It's just not going to happen. When the trend is down, you have to wait till sentiment gets really extreme on the downside, and you also have to look for a confluence of strong technical support, and that's what we have around 1260. So that's why I'm thinking we have downside to 1260 over the next month, and that's where the next rally could come from. But ultimately, aside from gold or the dollar, if there's one chart or ratio we'd watch, it's gold against the stock market, because that every time gold has popped up in the last 18 months, it hasn't been able to sustain the strength in that ratio, and it's still in a downtrend. It's below the 200-day moving average. So unfortunately, the trend for gold may be turning lower, as we're speaking. So I was expecting a summer breakout. Now I'm not. Who knows? Maybe I'll be wrong. But at this point, I think the risk for the rest of the year is, neutral at best. I would say neutral to down in gold. And you have to be careful here. You have to be defensive. And ultimately, when the Fed is done hiking rates, that's going to be the point in time when a real bull market is going to begin in precious metals. And as far as the timing on that, it's just a guess, but I'd say maybe 9 to 15 months, or we could average it and say about 12 months from now. Sometime next year would be my guess. That's what we have to wait for. And in the meantime, we have to be conservative and defensive. And that's all in this video. I hope you enjoyed it. You can follow all of my work at thedailygold.com. You can check out my premium newsletter at thedailygold.com/premium. I focus on market timing and then stock selection in the juniors. If you want to know which juniors really have the goods and best potential, you can sign up for my service. It's highly affordable. I have great industry sources, so I learn and I know, which are the companies that have really good projects and which are the companies that do not. And so if you sign up, I'm happy to answer any subscriber emails and let you know my opinion of whatever stocks you want to ask about. Thank you so much for listening and watching. I really appreciate it, and I look forward to publishing another video update for you in the weeks ahead.